Hello, everyone, and welcome to another episode of the Ontario Mortgage and Real Estate Insights podcast. I'm your host, Steve Hamoan. Today, we're diving into some critical insights about the Canadian economy, specifically focusing on the job market and its potential impacts on the mortgage sector. We've got some interesting analysis from RBC, which suggests that while many Canadians have been primarily concerned about mortgage renewals, it's actually the job market that might pose a bigger risk to our economy. For the past couple of years, the fear of a mortgage renewal cliff has loomed large over Canada. With the Bank of Canada implementing aggressive interest rate hikes, many expected this to cause significant economic disruptions. However, a recent report from RBC indicates that these concerns haven't materialized as severely as anticipated. Instead, they warn that a weakening job market and rising unemployment rates could be a bigger threat. RBC economist Nathan Jansen highlights that although mortgage renewals will indeed present challenges and likely slow down economic growth, they are not expected to lead to a full-blown economic crisis. This is largely because two key conditions need to be met for the situation to remain manageable: a reduction in interest rates by the Bank of Canada and a stable job market. While we've seen some rate cuts, the job market is where the real concern lies. As of September, the national unemployment rate was recorded at 6.5%, a slight improvement from the 6.6% in August, which was the highest since 2017. However, this is still a significant increase from a low of 5% in early 2023. Major metropolitan areas such as Toronto, Edmonton, and Windsor are experiencing even higher unemployment rates, over 8% in some cases. Jansen notes that a 1% rise in unemployment typically translates to a 0.5% reduction in household disposable income, which can have substantial ripple effects across the economy. RBC predicts that the unemployment rate could rise gradually to 7% by early 2025. Meanwhile, Oxford Economics sees it potentially peaking at 7.3% by late 2024 or early 2025. This is more than a percentage point above pre-pandemic levels, and Jansen warns of further deterioration if job openings continue to decline. Over the past year, job vacancies have dropped by 25%, which, if it continues, could exacerbate the unemployment situation. On a slightly more positive note, the Bank of Canada's recent interest rate cuts have provided some relief in the mortgage sphere. So far, rates have been reduced by 75 basis points, offering many Canadians reduced payments or increased contributions towards their principal. Lenders have also been cutting fixed mortgage rates during the summer, driven by declining bond yields. These changes are giving borrowers more breathing room as they approach their mortgage renewals. 5-year government bond yields, which influence 5-year fixed mortgage rates, have dropped, as have 2-year bond yields, which affect 1 to 3-year mortgages. Many of these mortgages are set to renew at lower rates, providing relief to variable rate mortgage holders through reduced payments or increased principal contributions. However, those with 4- and 5-year fixed-rate mortgages may still face higher payments. Despite these challenges, Jansen points out that the interest rate cuts have tempered the potential increase in total mortgage payments, which are expected to rise by only about 0.1% of total household disposable income in 2025. Additionally, high home prices and significant homeowner equity offer borrowers some flexibility, such as refinancing with longer amortization periods to lower monthly payments if needed. Recent survey findings reveal that 2/3 of Canadians are not ready to buy or refinance their homes, even if the Bank of Canada announces a rate cut in October. Despite the anticipation of a potential rate drop, a significant 66% of Canadians considering buying or refinancing said they're unlikely to move forward within the next 90 days, according to a survey by everyrate.ca. So, what's holding Canadians back? Well, interest rates are certainly a crucial factor in home buying and refinancing decisions, but this survey suggested that even a modest rate reduction might not be enough to prompt action for many. Of the 47% of respondents who said they're currently considering or very interested in buying or refinancing, only 34% would take action within the next 3 months. This group primarily consists of younger Canadians aged 18 to 34, first-time homebuyers, and those with higher incomes, over $100,000, who are more prepared to take advantage of rate cuts. Interestingly, residents of Alberta are the most eager, with many ready to act quickly if rates drop, while 27% of Ontario residents say they would likely make a move within the next 90 days. However, of those surveyed who are very interested in buying or refinancing, only 10% said they would make a move immediately after a rate cut. Another 24% would consider entering the market within 90 days, but a notable 21% are holding out for further rate cuts, and 45% indicated that rate changes wouldn't affect their decision at all. Meanwhile, 66% of this group are still on the fence, waiting for more substantial rate cuts or better economic conditions. This includes many older Canadians, those over 55, lower-income households, and residents of Manitoba and Saskatchewan. Despite interest in home buying or refinancing, many Canadians are holding back due to a combination of factors beyond just mortgage rates. High housing prices and broader economic uncertainty are influencing these decisions. While a rate cut might nudge some prospective buyers into action, the survey suggested that many are looking for more dramatic improvements before they feel comfortable making a move. Andy Hill, co-founder of everyrate.ca, noted in the report, "While it's promising that a segment of Canadians are poised to act on upcoming rate drops, the reality is that over two-thirds are still waiting on the sidelines." This tells us that minor rate adjustments aren't enough. Canadians are looking for more substantial changes before they feel confident to jump into the market. The survey, conducted by Ledger from September 27th to 30th, included 1,626 Canadian adults and was weighted to reflect the Canadian population. While the results come from a non-probability sample, the margin of error for a comparable probability sample would be plus or minus 2.4%, 19 times out of 20. Let's take a closer look at the latest figures on Canadian housing starts, which have shown some intriguing dynamics in the month of September. According to the Canada Mortgage and Housing Corporation, or CMHC, while the 6-month trend in housing starts has decreased by 1.3% from August to September, the monthly seasonally adjusted annual rate of total housing starts has actually risen by 5% from the previous month, reaching 223,808 units. This increase is primarily driven by urban centers with populations of 10,000 or more, where housing starts have jumped by 6% to 210,002 units. Both multi-unit and single-detached urban starts have seen notable increases of 6% and 5%, respectively. However, the long-term trend paints a different picture, with the 6-month moving average reflecting a decline, settling at 243,759 units. Year-to-date figures tell us that there has been a 2% increase in actual housing starts from January to September 2024 compared to the same period last year. This growth is largely attributed to higher multi-unit and single-detached starts in regions like Alberta, Quebec, and the Atlantic provinces. However, Ontario and British Columbia are experiencing decreases across all housing types, which is a concerning trend for these key markets. Kevin Hughes, Deputy Chief Economist at CMHC, emphasizes that despite September's uptick, housing starts remain well below what is required to restore affordability in Canada's urban centres. This is an important point, as it highlights the ongoing challenge of meeting housing demand in major cities. Regional variations are also significant. For instance, Montreal has shown a 15% increase in year-to-date starts compared to 2023, signaling a recovery from historically low construction levels. Conversely, Vancouver and Toronto are seeing declines of 19% and 20% respectively, which are measured against record-high years in 2023. This suggests that while some regions are bouncing back, others are still struggling to maintain the momentum seen in previous years. Ottawa's recent mortgage changes have been a hot topic, and for good reason. These changes, aimed at helping first-time homebuyers, could have some unintended consequences, according to a new analysis from TD Economics. While the changes are designed to provide a boost in affordability for first-time buyers, they might also introduce new vulnerabilities into the Canadian financial system. Rishi Sondhi, a TD Bank economist, has analyzed the Liberal government's plans to expand the availability of 30-year amortizations for all first-time homebuyers. Additionally, the government plans to raise the price cap for insured mortgages to $1.5 million, up from the current $1 million. Both of these changes are slated to take effect on December 15th. Longer amortizations can help potential buyers qualify for larger mortgages by reducing the monthly carrying costs. Sandy estimates that this could lead to an increase in purchasing power of around 9% for the typical homebuyer. These moves are expected to stimulate home buying in the first half of 2025, with sales and home prices projected to be 2 to 4 percentage points higher by the end of 2026. However, Sandy warns that the initial boost in affordability from longer amortizations could be completely eroded within 2 years due to rising prices tied to the policy itself. It's a double-edged sword, he notes, offering a near-term increase in activity, but potentially worsening affordability in the long run. Raising the insured mortgage cap to $1.5 million will allow more Canadians to access pricier homes without having to put down 20% upfront. This move targets first-time homebuyers and allows them to qualify for an insured product with less than 20% down, which is considered a higher loan-to-value mortgage. Sandy's report estimates that approximately 1 in 5 homes in Canada are currently valued between $1 million and $1.5 million. The most significant impact from the higher insured mortgage cap is likely to be felt in Toronto and Vancouver, where many homes fall within this price range. Finance Minister Chrystia Freeland has defended the proposals, stating that they are meant to give first-time homebuyers a leg up in the housing market. However, Sandy argues that the policies miss the mark in truly aiding first-time buyers, as many lack the income levels required to qualify for such sizable mortgages. A household looking to buy a property worth $1.45 million would need an annual income exceeding $225,000 to qualify for the mortgage, Sandy calculates. This is a stretch for many households, let alone first-time buyers. Moreover, policies that result in more high loan-to-value mortgages could add fragility to the Canadian financial system. Sandy cites research from the Bank of Canada, which indicates that higher loan-to-value ratios increase the risk of homeowners defaulting on their mortgages. Longer amortization periods also reduce a household's ability to absorb financial shocks. Homeowners with 25 years or less remaining on their mortgages can extend their amortizations to mitigate rising rates, but starting from 30 years limits this flexibility. Canada already has a highly indebted society, and these policies could exacerbate debt levels, potentially intensifying risks to the financial system if a downturn hits the economy. They are factors that can amplify a recession, Sandy warns, raising vulnerabilities in both the financial system and the broader economy. Now let's turn our attention to the Bank of Canada's upcoming interest rate announcement, which is creating quite a buzz in the financial world. With the inflation rate now under the target of 2%, there's speculation that the Bank of Canada will drop its interest rate next week. This potential move comes after a period of elevated rates aimed at controlling inflation, which had previously peaked at 5%. The current interest rate stands at 4.25%, but financial experts are predicting a significant drop. According to Canadian Mortgage Trends columnist Steve Hubel, CIBC is forecasting that the Bank of Canada could introduce what they're calling jumbo rate cuts, potentially slashing interest rates by as much as 50 basis points at a time. This would be a substantial shift, and CIBC, along with National Bank, are the only two among the big 6 banks currently predicting the policy rate could fall to 3.50% by the end of this year. The reasoning behind these predictions is largely tied to the recent drop in the annual inflation rate, which hit 1.6% in September, marking the lowest rate since February 2021. When inflation was high, the Bank of Canada had raised rates to curb spending and bring inflation down. Now, with consumer spending easing and inflation falling, there's room for potential rate cuts. This anticipated rate cut is particularly relevant, given that more than 2 million mortgages in Canada are expected to come up for renewal over the next 2 years. Many of these mortgage holders are still enjoying lower rates from earlier periods, but they could face higher rates at renewal if the cuts don't materialize as expected. A recent survey by Ledger, conducted for everyrate.ca, revealed that most Canadians remain hesitant to make significant mortgage decisions, even if the Bank of Canada cuts rates again on October 23rd. The survey, which polled 1,626 Canadians, found that 66% of respondents said a potential October rate cut wouldn't prompt them to buy a home or refinance within the next 90 days. They're waiting for a more substantial drop before taking action. This sentiment echoes what we've been discussing throughout this episode. Minor rate adjustments aren't enough to spur major market activity. Canadians are looking for more significant changes before feeling confident enough to jump into the housing market. This cautious approach is understandable, given the broader economic uncertainties that we're facing. While the upcoming interest rate announcement by the Bank of Canada could provide some relief, it's clear that many Canadians are in a wait-and-see mode, hoping for more dramatic shifts in the economic landscape. As we wrap up today's episode, it's important to keep an eye on these developments, as they will undoubtedly shape the real estate and mortgage markets in the coming months. Thanks for tuning in to this episode of the Ontario Mortgage and Real Estate Insights podcast. I hope you found our discussion today insightful and informative. Be sure to join us next time as we continue to explore the evolving landscape of real estate and mortgages in Ontario. Until then, stay informed and make well-informed decisions. Goodbye.